Good afternoon, everybody. We're going to get started with today's presentation, and boy, I got to tell you, I'm pretty excited about this. We had just finished our Q2 quarterly theme about selling options. It culminated in a live in-person seminar that we did in New York City, and today begins our Q3 topic where we're going to be talking about options as an efficient use of capital. One of the comments that we get a lot during our presentations is that we don't do enough material for beginners. We don't cover the basics enough, and we do notice that at least half of our audience are beginners when it comes to options. So we're going to start with the basics today about buying options, again, using options as an efficient use of capital. So I certainly hope for you beginners that you get something out of this. And again, if you have any questions, we've got our dynamic duo of Bill Ryan and Ken Keating from our investor services team on the line as well. They're going to be taking your questions as they come in for a live Q&A, and then we'll also take some questions from the audience at the end of the session. To get things started, my name is Mark Benzequin. I am the manager of the investor services team here at OIC. I've been in the business for a little bit over 20 years now, on the trading floor for most of that time, and I've been here at OIC now for about 3.5 years. And one of the terrific things about it is presenting material and education to all levels of investors, whether they be beginners, intermediates, or some of the more advanced investors. And it's really a terrific job. It's the teaching and the talking and the getting to know our investors and our clients that I really, really enjoy. So very excited for today's presentation. We're going to be talking about buying options and what you need to know. Before we do that, we're going to take care of a few housekeeping items. The disclaimer for those of you that haven't seen this, basically it's telling us that options involve risks and may not be suitable for everybody. As a matter of fact, when you open an account, your broker is going to insist that you read and understand the characteristics and risks of standardized options booklet. It's available from your broker, or you can write to us or drop us a note here at OIC, and we'll be happy to get you a complimentary copy. Also, to keep things simple, we're not really going to be talking about commissions or fees or other costs that go along with your trade that can impact your account and the profitability of that trade. And then again, any strategies that we talk about today, all the examples, it's just simply going to be for illustrative and educational purposes. For those of you that aren't familiar with OIC, the Options Industry Council, we are a free not-for-profit service where we provide unbiased options education. We do that mainly through our website, optionseducation.org, where we've got podcasts and videos. We do this twice-a-month webinar program. We have a live chat feature as well on our website where you can talk live with an options professional, and you can always email us at options@theocc.com, and you can reach our investor services desk during regular trading hours. We'd love to talk to you. In terms of options in general, they trade on these 5 primary exchanges. You can see the CBOE, the NASDAQ, the BOX, which is the exchange in Boston, the New York Stock Exchange, and the exchange in Miami. And that's where all of the options volume occurs. You can see in 2018 we had a record year in options volume, clearing over 5.2 billion option contracts for the year, well and above any previous years. 2019, we're off to a great start, certainly nothing like 18, but we're still averaging about 19 million contracts a day. So with that being said, let's go ahead and get into our presentation outline. Again, like I said, we're going to keep things simple and basic for our beginner investors. We're going to talk about buying options, specifically the rights and obligations that options confer upon the buyer and or the seller, the process by which we make good or due on those rights and obligations. That process is exercise and assignment. So we're going to go over that as well before getting into some of the more complex or intermediate concepts when it comes to options trading. We're going to talk about different pricing considerations. The Greeks, for example, I saw that we had a question already come through the Q&A about the Greeks, so we are going to talk about some of the more important Greeks that affect your options trade. We're also going to talk about the intrinsic and extrinsic value, as well as the elusive concept of volatility. Let's go ahead and get right into it. Rights of options buyers. When it comes to options trading, we've got buyers and we've got sellers. Buyers, whether it be a call or a put, buyers are in the driver's seat. And what I mean by that is the option buyers call the shots. They have the right to buy or sell shares of stock at the strike price. Buyers of call options have the right to buy stock. Buyers of put options have the right to sell stock at that strike price if they exercise the contract. And that's an important concept. If they exercise the contract. If not, then that option simply is going to expire worthless. Now, whether or not it is in the buyer's interests to exercise the contract is something that we'll get into a little bit later when we talk about intrinsic versus extrinsic value. If the buyer wishes to exercise their contract, they're simply going to issue their broker an exercise notice. Basically, they're going to tell their broker, I want to exercise the contract. I want to enforce the terms of this contract, which is really what exercise is for the buyer. They want to enforce their right, or in the sense, exercise their right to buy those shares. In the case of a put, they want to exercise their right to sell those shares. The process by which exercise occurs with many of the brokers out there, it's going to be an automatic process, meaning if your option finishes in the money, again, which is something that we'll get into in just a bit, but basically in the money, if my contract has value at expiration, and let me just backtrack a second. At expiration, it's really a binomial occurrence. Your option either has value or it doesn't have value. There's no in between. It's either worth something or it's worth nothing. If it's worth something, then the buyer can go ahead and exercise their contract. The process by which that happens automatically, if it finishes in the money, that's called auto exercise, where the buyer doesn't need to do anything. Your broker will automatically exercise that contract for you. For that right, again, option buyers have rights, and for that right, you're going to pay a premium. That's going to be the cost of the option, and we look at it in terms of a $100 multiplier. So if you look at your option chain and it says that the premium quoted on the market is a $3 premium, for example, it's going to cost you $300 in the real world. That premium with option buyers, and this is one of the great things about buying options, especially when you're starting out, that premium also represents the maximum amount that you can lose when purchasing that contract. That premium is going to be your maximum amount of risk. So in the above example, if we paid $3 for that option, again, in the real world, that's going to be $300. That's the most that we can lose on this option contract. So if the market goes the wrong way on us, we can only lose what we put into it. So exercise, let's look at this a little bit in more detail. Here's an example. Our stock is trading $79. Now our buyer has a forecast, right? Every time that we do a trade, whether you're a buyer or a seller, you begin with a forecast and a motivation. What do you think is going to happen to the stock? Where is it going to go? How long is it going to take to get there? And what's the reason you're doing the trade? So in this particular case, our buyer happens to be bullish. When we buy calls, we typically have a bullish mentality, meaning that we think the stock is going to go up. So our buyer thought the stock was going to go up. It was trading $79. They decided to purchase an $80 call expiring in September later of this year. The premium on that call was $1.50. So what's the maximum that they could lose on that trade? Well, again, that's going to be the premium that they paid. So $1.50 or $150. That's going to be their maximum risk. So here we are. Let's fast forward a couple months. We're September 20th, expiration Friday. Stock is now trading $84, and our buyer decides to exercise the call. The buyer is now saying, I have the right to purchase shares at $80. Stock is trading 84. I'm going to go ahead and exercise my right to buy those shares. So what the buyer does is they pay their strike price, that $80 strike. They pay that times $100, that's our multiplier, or $8,000, and they take delivery of 100 shares of stock. With the stock currently trading 84, they're buying 100 shares of stock, $8,000 worth of cost, and they're receiving $8,400 worth of value. Now they have an unrealized profit of $250. That's simply going to be the value of the shares that they obtained minus the exercise value that they paid, the $8,000 that they paid to get those shares, minus the $150 premium that they paid up front. So that gives them an unrealized profit of $250. And the reason I say unrealized is because they currently own those shares. So now that they own those shares, their risk is now in long stock. So if stock overnight happens to drop down to $20, well, they're not going to make that $250. So that profit is unrealized until they unload those shares if they decide to do so. So now our investor has a risk-reward relationship of being long 100 shares of stock for $81.50. So they can exercise the call, or they can simply sell that option back to the market. If stock is trading 84, that $80 call is going to be worth $4. That's the intrinsic value of that option, and again, as I had mentioned, we'll explain that in detail in just a moment. So the intrinsic value of that option is $4. They can just sell it back to the market to close, collect $4 for the option that they paid $1.54 up front. They get their $250 profit that way. One thing that you may have heard, a statistic, is that the overwhelming majority of options expire worthless, and only about 10% or so of options actually get exercised. Even though that statistic is correct, it's a bit of a misnomer. The reason being is that the overwhelming majority of options, well over 70% of options, get traded back into the market prior to expiration. So the reason they're not exercised or they are getting assigned is simply because the investor closed it out ahead of time, and hopefully for a profit. So exercise is simply where the buyer of the option, again, whether it be a call or put, is basically saying, I've got the right to buy or sell these shares at the strike price. I'm going to go ahead and exercise that right. Now, on the flip side of it, we've got option sellers. Whereas buyers have rights, sellers have obligations. When it comes to a call, the seller has the obligation to sell shares. With the selling a put, the seller has the obligation to buy shares, again, at the strike price if they get assigned. The assignment notice that they receive, that's going to be coming from your brokerage firm, and only sellers can get assigned on an option contract. The one thing about assignment is that you have no choice. I mentioned that the buyer is in the driver's seat, the buyer's in control. The seller has no control over their option contract. They are obligated to fulfill those terms if called upon to do so. The only way the seller can avoid that obligation is to close out their contract ahead of time and buy that contract back to close. The way assignment looks like is this. This is the flip side to our call buyer. Here we've got a call seller. They sold the $80 strike at $1.50. They kept that premium. Now, whereas an option buyer, that premium represents your maximum risk. With an option seller, that premium represents your maximum reward. So stock is now trading $84. Our seller gets assigned. We collect our strike price times 100, so we collect $8,000 now, and we have to deliver 100 shares of stock. That stock valued at $8,400. So we've got an unrealized loss. We collected $8,000 when we were assigned. We also collected that $150 premium up front, but we delivered $8,400 worth of stock. So we've got an unrealized loss of $250. If we hold on to those short shares, or if we hold on to that responsibility of short shares, I should say, we've got a new risk-reward scenario of being short 100 shares of stock at 81.5. And when it comes to short stock, that's definitely something you're going to want to discuss with your broker because they have specific and strict policies and protocols as to how short stock is treated. So definitely make sure that you discuss that with your broker and that you understand the policy. Exercise and assignment process, it simply begins with our investor. As I mentioned, you notify your brokerage firm that you're looking to exercise your contract. They notify their brokerage firm, which is known as a clearing member firm, who then notifies the OCC, the Options Clearing Corporation. The Options Clearing Corporation then randomly assigns a clearing member firm who has a client that has a short position in the particular option contract that's being exercised. That clearing member firm will then randomly assign a brokerage firm who has a client who has a short position in that option contract that was exercised, and then that brokerage firm will randomly assign an individual investor. So the assignment process, you guessed it, keyword is random. It is an SEC-approved process that the OCC employs. There is no first in, first out, or last in, last out process. It is entirely random. So that's how exercise and assignment works. Now, let's go ahead and get into some of the more esoteric concepts of option trading and answering the question that came in a little bit earlier, the Greeks. The Greeks are simply a way to interpret what we think is going to happen to the option price based on certain changes in the market. Option prices are simply a function of supply and demand, meaning the individual investors, the investment banks, hedge funds, the market makers, trading, the traders on the trading floor, all of these market participants put out their best bid, what they're willing to pay for this particular option contract, or their best offer, what they're willing to sell that option contract for. And it's simply a function of supply and demand, best bid, best offer. The more market participants looking to buy something, that's going to drive prices up. The more market participants looking to sell something, that's going to drive prices down. The Greeks are a pricing concept that helps us make sense of what we think is going to happen to that option contract based on some of those underlying changes. You can see we've got the most five popular, or I hesitate to say useful, but the most common Greeks that people use. Delta, first and foremost, delta is the expected change in the value of the option in relation to the underlying stock price changing. So for every dollar that the stock price changes, the option is going to change by a certain percentage. That percentage is known as the delta. And we'll explore that in detail in just a moment. Gamma is going to be the expected change in the option's delta as the stock price changes. Theta, you may have heard of. Theta is also known as time decay. And that's basically saying is that each day ticks by closer to expiration, the option is going to lose a certain percentage of its value based on those days. Again, theta is something important with buyers, so delta and theta we're really going to explore in a fair amount of detail next. Vega is the change in the option value with the change in implied volatility, and we'll talk about implied volatility momentarily. And Rho is basically the least looked at Greek. It's the expected change in the value with the change in interest rates. The reason that it's least looked at currently is because we're in a very low interest rate environment in the market. However, if you're looking at longer-term options, trading leaps, which are options that go out about 2.5 years or so, then Rho certainly might be a little bit more important, as we have no idea what interest rates will be 2.5 years or so down the road. So a very, very quick overview with the Greeks right there: delta, gamma, theta, vega, and Rho. Let's look at delta a little closely. Again, it's the change in the option price, and really here's the key word, it's the expected change in the option price for every 1 point move in the underlying stock. If the stock goes up $1, we expect the option to increase or decrease by a certain percentage. Deltas are represented anywhere between 1 and 100, or 0 and 100, or as a fraction. So a deep in the money option, that's going to have the deltas approaching 100. At the money option, deltas around 50, and far out of the money options, those deltas will approach 0. What we mean by in the money, at the money, and out of the money, in the money options have intrinsic value, at the money and out of the money options have no intrinsic value. And another way to look at delta is the possibility or the probability that the option is going to finish in the money. So if we have a deep in the money contract, the likelihood that that contract stays in the money through expiration is going to be very high. So it's going to have a very high delta, and that also means is that as the stock moves, the value of that option is going to move considerably as well. If, for example, we had a 90 delta option, for every $1 that stock goes up, and assuming we're talking calls, every $1 the shares increase in value, that call would increase by about 90 cents. At the money options, delta's around 50%. Every $1 the stock moves, that option is going to move around 50 cents. And then far out of the money, every $1 the stock moves, the option isn't going to be affected that greatly. Calls have positive deltas, meaning as the stock goes up, the value of the call goes up. As the stock goes down, the value of the call goes down. Puts have negative deltas. Stock goes up, value of the put goes down. Stock goes down, value of the put goes up. And here's an example. This is from our OIC online options calculator. We've got a starting stock point of $100, and we're looking at the $100 strike. The call value, as you see there on the right, is a little over $3. The put value is about $2.80. Both of them trading roughly around 50 delta, 53 on the call, 47 on the put. As the stock goes up $1 to 101, you can see our call value now has changed to $3.62, while our put value has dropped to $2.35. That's the effect of delta. You can also see that the delta itself changed. 53 delta when stock is trading 100, 58 delta now that the stock is trading 101. That's going to be the effect of gamma. Gamma is going to be the change in delta based on the change in the stock price. And then as the stock goes down, say to $99, our call value now drops to $256. Our put value now increases to $330, and again, the delta changes accordingly. So when it comes to the Greeks, delta in particular, delta is going to tell us how much we can expect the shares to move up or down, or I should say the option price to move up or down based on the share price. And again, I had mentioned that another way that investors use delta is to determine the probability of that option finishing in the money. So theoretically, if we had a 70 delta call, that would indicate a 70% chance that that stock is going to finish in the money, whereas a 30 delta call, if we sold that, it would indicate a 70% chance that the option finishes out of the money. Buyers want options to finish in the money. Sellers want options to finish out of the money. Now, one thing that we need to make clear, the probability of the option finishing in the money, that does not equate profitability. I can have say a 50 strike call, and the stock finishes at $50 and a nickel. So my option contract finished in the money by 5 cents. Technically, I'm in the money. But if it cost me $2 to buy that contract, it's only worth a nickel at expiration. So even though it finished in the money, I'm not profitable. I actually lost $1.95. So definitely something to keep in mind. In the money and out of the money does not equate profitability. So let's look at our next Greek here. We've got theta. And the reason that we look at theta is, again, it's that time decay. So as the days go by, the passage of one day, the option is going to decrease by a value or by a percentage, and that value or percentage is going to be known as theta. Generally, long options have negative theta and short options have positive theta. What I mean by that, if I buy an option for $2, 10 days from now, that option is going to be, and assuming everything else stayed the same, assuming the stock hasn't changed, volatility hasn't changed, interest rates haven't changed, etc. 10 days from now, the value of that option is going to be less than what I paid for it, simply because we've got the passage of time. And that time is calendar days, not business days. So as a buyer, if I buy something for $2, my intent is that down the road, I'm going to be able to sell it for more than $2. As a seller, if I sell it for $2, my intent is down the road, I'm going to be able to buy it back for less than $2. So generally speaking, long options, when you're buying options, it has negative theta, meaning that time is always working against you. While you're selling options, we like to think of it as positive theta because that time is working in your favor. So let's go ahead and look at theta. Again, I had mentioned that decay is per calendar day, not trading day. You can also look at it as rent. That theta is similar to rent that the buyers pay and the writers receive. Again, buyers want that time for a more favorable move in stock price, meaning I want that stock to increase in value. I need more time for that to happen. It's more likely to happen over the next 3 weeks than it is in the next, say, 3 hours. So that rent or that time premium that I'm paying gives me more time to get my end goal to come to fruition. Whereas writers sell that time. It's also risk for option sellers. The more time that they have, the more chance there is that the option is going to go against them. So you can think of theta as rent buyers pay and sellers receive. And then only time value decays, meaning, again, at expiration, the option is either worth something, that's going to be its intrinsic value, or it's going to be worth nothing. So at expiration, theta is going to be the fastest. You're going to get 100% decay because in the morning on expiration Friday, let's say the option might be worth 25 cents. By the end of the day, if it expires worthless, it's lost 100% of its value. And we'll look at that graphically in just a moment. So let's look at a quick example of theta. Today, the option's worth $3.50. It's got 3 cents worth of theta, meaning that every day that ticks by, that option is going to decrease in value by 3 cents. And as we know that the contract, $3.50 is really $350 in the real world, tomorrow we would expect that option to be worth $3.47, assuming that nothing else happens to disrupt the value of that contract. So theta is going to be the amount or the value of your option that it decreases on a daily basis. But here's the key fact of theta, and the reason we're looking at it when it comes to option buyers is this. As you can see, theta is not constant, meaning that 3 cents that we talked about on the previous slide isn't going to be 3 cents every single day until expiration. Depending on the term of the contract, how long it is, it may only be a fraction of a penny for the first several months, fraction of a penny each day over the first several months. As we near expiration, that decay is going to increase exponentially. It's going to accelerate as we near expiration to where on the day of expiration, as I had mentioned, it's going to decay by 100%. Now, the reason that it's important for buyers to know, and sellers for that matter, is that that rate of decay typically accelerates between 30 and 45 days out until expiration. So option buyers, if they buy a contract expiring a week from now, if there's any time value to that option, that time value is going to decay rapidly. So they're going to lose money quickly on a daily basis simply because of that time decay. Now, obviously, if the stock increases in value or if volatility increases or other factors affect the value of that option, it may offset the decline in the value of the option from theta, but it's definitely something to keep in mind. Longer-term options have a slower decay, therefore option buyers typically maybe look to buy a little bit more longer term. Option sellers, however, may look to sell shorter term simply because they want that quick rate of decay. So definitely two things to keep in mind when looking at buying or selling options. Specifically with the buyers, to paraphrase Mick Jagger, time is not on your side. So definitely something to keep in mind. Buying shorter term options, that decay is not going to be your friend. Intrinsic versus time value. So all of those option concepts that we just talked about, we talked about decay, for example, and theta. Those things affect the extrinsic value of your option. There's two main components of option pricing: intrinsic value and time value, also known as extrinsic value. So as part of your option premium, the intrinsic value and time value, that makes up your entire option premium. The intrinsic value is simply the in-the-money amount. If I've got a 50 strike call and stock is trading $55, intrinsically, inherently, that option is worth at least $5. If the option's trading $5.50, $5 of that is intrinsic value, 50 cents of that is going to be time value. So any premium in excess of that intrinsic value, that's going to be the time value, and that's going to be the portion that decays as the days tick by. So again, as I had mentioned, at expiration, options are only worth their intrinsic value. If the option is at the money or out of the money, it is going to expire worthless. And think about it this way. If I had a 50 strike call and I were to exercise it, I would pay my strike price times 100, $5,000, and I would receive 100 shares of stock. If the value of that 100 shares of stock is more than $5,000, then my contract has value and I want to exercise it. That's the intrinsic value portion of the contract. If I were to pay $5,000 and only receive $4,800 worth of shares, well, that's not going to be a trade that I want to do every day if I want to stay in business as an investor. So I would go ahead and let that option expire worthless because it has no intrinsic value. And at expiration, one of the big components of time value is time till expiration. Once that time is gone, there is no value left. So here's an easier way to look at it. We've got our option premium. It's made up of intrinsic value, which is simply going to be the difference between the stock price and the strike price. In the example I used, $50 strike price, $55 stock, let's say, intrinsic value $5, the difference between those two. Now, time value or extrinsic value is made up of a couple different components. We've got time, obviously, first and foremost. We also have volatility, and we'll talk about volatility in just a moment. And then we've got interest rates and dividends. So those four components affect the extrinsic value or the time value of those options. And any one of those can work against any of the others. So, definitely something to familiarize yourself for those beginning option investors. Familiarize yourself with time value and the components that go into it, because they definitely will affect your option contract. So in the money calls and puts, as we mentioned, they have intrinsic value. They may have time value on top of it. If we've got a $5.50 option, stock's trading 50, and we've got a $50 strike. Stock is trading 55. Option is trading $5.50. That option is going to have $5 of intrinsic value, the difference between the share price and the strike price. Anything left over, that's going to be the time value. when it comes to at-the-money calls and puts or out-of-the-money calls and puts, there is no intrinsic value. The entire premium is made up of time value, which is why it's so important to understand time value or extrinsic value and how it could work for you or against you, because at-the-money and out-of-the-money calls and puts, that is all that they have. They're entirely made up of time value. So volatility, as I mentioned, volatility is one of those components of that time value. And it's also one of the least understood or the most misunderstood option concepts there are. And let's see if we can't make a little bit more sense of that for you and try to put things in some simpler terms. So historical volatility, that's the easy part. That's the price movement of the stock in the past. And we can look at it over the last 2 weeks, 2 months, 2 years, what have you. Now, that's not necessarily saying that the stock was at $20 and now it's at $50. What the volatility mentions, or what the volatility measures, is where the stock goes throughout the trading day. If stock is $20 at the open and it closes at $20, does that mean that the stock is volatile or not? Well, most people would say no, it isn't. But what if it opened at 20, went up to 30, went down to 10, back up to 40, down to 3, up to 60, and finally closed at 20, all in the same day? Obviously, that seems pretty volatile, right? Even though it opened, it closed at the same point, it whipped around all day long. So that we would consider that an extremely volatile stock. Now, the implied volatility is simply the historic. Historic is a bad description here. Volatility, implied volatility, is basically the market price of the option, or what the market is telling you the future volatility of that underlying stock is going to be. So remember, we had talked about if stock opens at 20 and closes at 20, and yet it whips around all throughout the day. The implied volatility is what the market is saying is going to happen to those shares at some point in the future, and it's inferred from the price of the option. You can look at it as historic volatility is what had already happened. Implied volatility is what we expect to happen. And the implied volatility can be at great variance with the stock's historical vol. What I mean by that is that the stock can be flat, right? The stock can, be trading 20 one day, 20 the next day, 20 the next day, and not really moving around. But if there's some event on the horizon, whether it be earnings, a Fed announcement, for example, a pharmaceutical company, if they've got a drug trial or a drug test trial that's coming due for a cancer drug, and if the test is positive, if the test comes to be successful, then the stock is going to shoot up in value. If the test proves negative, then maybe the company goes bankrupt. So the option would take those implications into consideration when the market determines a price. Remember, as I said, the market is simply a function of supply and demand. And if you've got a lot of people thinking that the cancer drug is going to be successful, they're going to bid up the price of that stock, or I should say bid up the price of those options. So in implied volatility, it doesn't necessarily need to be the same as the historical volatility. And one thing about it, when people talk about expensive options or cheap options, what they mean is the implied volatility levels in relation to its historic. If historically the stock is trading at a 30% volatility, and yet options are trading at a 15% volatility, and I see some of the questions coming in, where can I find these volatility numbers? You can certainly find them on your broker's trading platform, I would expect. You can also find them on our optionseducation.org website. We have a delayed quotes page that, in addition to the Greeks and bid-ask prices, etc., it also has implied volatility data. So back to my example, if stock historically is trading a 30 vol, options are trading a 15 vol, an investor may look at that and say, well, here's a great buying opportunity, because typically volatility reverts to the mean, meaning that we would expect the implied volatility of the option to eventually get back to get in line with its historical vol levels. So if implied volatility is 15%, we would expect that implied volatility to increase at some point, and because of that, some investors may see it as a buying opportunity. As volatility increases, option prices increase as well. Whether it's a call or a put, both calls and puts will increase in value as volatility increases. And again, we generally see that around an unknown event, again, whether it's earnings season, a Fed meeting, something like that. Conversely, if implied volatility is above its historical levels, then investors may see that as a selling opportunity, thinking that the volatility is going to decline, and as it does, option prices are going to follow suit. So this addresses what I just spoke about. Will the implied vol return to its historic level? It's not necessarily, and it's not to say that that's going to be the case, but we're concerned about implied vol because it directly affects that time value. Again, as volatility increases, the value of that option is going to increase, the time value is going to increase. Option buyers, that's a great thing. Option sellers, not so much. So the effect on the option prices, all other things remaining constant, if implied volatility increases, as I mentioned, the option prices are going to increase as well, both calls and puts. As volatility decreases, both calls and puts are going to decrease as well. The interesting thing about volatility is that the share prices is not necessarily a factor, meaning that there are many other things that might affect the volatility of the option besides the actual movement of the stock. When you think about implied volatility, we think of the unknown, right? We had talked about a specific event, earnings, Fed announcement, what have you. The reason volatility increases during those periods is because as an option seller, right, I'm the one that's got all of the risk. As an option seller, I'm accepting more risk by selling options when I don't know what's going to happen. I don't know the result of the earnings announcement. I don't know if the company is going to meet their earnings, if they're going to beat the street, if their forward language is going to be positive or negative. I don't know the results of that drug trial. I don't know what the Fed is going to do with interest rates, et cetera, et cetera, et cetera. Because I don't know what's going to happen with the market, I'm accepting, as an option seller, I'm accepting a tremendous amount of risk. Certainly, the further out in time that we go, which is one of the reasons why longer-term options are so much more expensive than shorter-term. As a seller, I don't know where the market's going to be. I'm accepting a tremendous amount of risk. To offset that risk, I'm going to demand being appropriately compensated. So that's why with the unknown, option prices rise, because option sellers are demanding more money for the risk that they are accepting, and option buyers are willing to pay more money because they feel they want to take advantage of that unknown. They feel that earnings are going to be good. They feel that maybe the Fed will cut interest rates, or they feel that that drug trial will be successful. So they're willing to pay more for the unknown, and the option seller is demanding more to sell into the unknown. So some different things that can affect implied volatility certainly a rise in the market. One thing that I'm sure that you've seen if you've been investing for any period of time, option markets and stock markets, and really any investment that you have out there, declines infinitely quicker than it appreciates in value. The market reacts to bad news much more quickly than it reacts to good news. So the implied volatility is going to fluctuate depending on that market sentiment. As I mentioned here in that third bullet point, panic is more often impressive than optimism. And what that simply means is that the change in the market is going to be quicker and more pronounced with bad news than it is with good news. You can see we've been in periods of low volatility for the last decade and a half. Some people call this the greatest bull market that ever was. The stock market has been on a slow grind upwards for the better part of 2 decades or so. There hasn't been a tremendous amount of roller coaster of up and down with the market. It's been a steady incline. Because of that, volatility has been low. And investors don't expect the market to be whipping around so much. But as soon as there's some bad news out there, the market declines precipitously, and the implied vol increases substantially as well. Taking a look at the VIX index, the VIX, that's the fear index that a lot of people talk about. When the market has a big downward day, you often see those implied volatility levels increase substantially. So let's go ahead and move on and look at an example of vol. Here's our 50 strike call. It's trading $3. Stock is trading $50 as well, and we've got about 2 months until expiration. Well, the next day, the stock moves around a little bit, as the example that I mentioned earlier, but at the end of the day, it's still trading $50. So the share price didn't change. It was trading $50 yesterday. It's trading $50 today. And yet the value of our option increased from $3 to $3.40. So our option increased more than 10%, and the market really didn't even move. And what's the reason for that? Always implied volatility. The implied volatility increased, the value of our option then increased, and theoretically we've got a profit. We bought the option for $3. Even though the stock didn't move, the implied volatility did. Theoretically, we can sell that option today at $3.40. One of the great things about buying options, it's the buy low, sell high. If I buy at $3 today and I could sell it out for $3.40 tomorrow, you can be sure I'm going to do that all day long. As my partner Bill Ryan is fond of saying, you'll never go broke taking a profit. So a lot of times investors, when they do have a chance for a fair profit, they're going to go ahead and take it, close that trade, and live to play another day. Now, the option seller, on the other hand, obviously isn't going to be very happy. The option seller sold this contract at $3, and today it's worth $3.40, so they actually lost money. So that increase in implied volatility helped the buyer and hurt the seller. So again, all of this goes back to those option components of time value, intrinsic value, extrinsic value, in the money, out of the money, et cetera. And all of those components, all of those concepts and factors will help you as an investor determine not only the value of the contract and whether or not you should buy or sell, but also what your risk could be, what the reward could be, and different things to look out for in the marketplace. So let's go ahead and just sum up with a few things that we looked at. Again, as I mentioned, buying options puts the investor in the driver's seat. The buyer is in control. They make the decisions as to whether or not they want to exercise or not exercise their contract. The good thing about option buying also is that the premium paid, that's going to be your maximum risk. One of the things when we travel around the country and attend trade shows and present to investors of all levels, the beginner investor or the novice investor, when it comes to options trading, when I do a presentation, I ask people, let me see a show of hands as to how many of you trade options. And the ones that don't, I then ask them, what's the number one reason that you don't trade options? And the number one reason they give me without fail, well, actually, they give me 2 reasons. One of which is they don't know enough about options to trade them, and that's where the OIC comes in with our education. But primarily, the answer that we get the most is that options are risky, that they've heard horror stories of people losing thousands to tens of thousands to hundreds of thousands of dollars trading options. One of the jokes that we used to have on the trading floor is that if you want to make a small fortune trading options, start out with a large fortune. Definitely one of my favorites. But in reality, options are only as risky as you want them to be. Buying options, we know going in that our maximum risk is what we paid for that contract. If I buy a contract for $1, it's $100 in the real world. I cannot lose, no matter what happens, I can't lose more than $100. When I buy a call, I've got unlimited reward and limited risk. And speaking of buying calls, that's something that our director, Ed Modula, will get into next week with his webinar as he talks about using options for speculation and leverage. But the point being is that options are only as risky as we want them to be. Selling options is often a different story, and there's different ways to mitigate risk when selling options. But when it comes to buying options, yeah, we know going in, eyes wide open, we know exactly how much we're risking. So that's one of the great things about options to me is that you've got minimum risk. We're talking about efficient use in capital. Look at it this way. You can buy 100 shares of stock for $50, right? $5,000. You've got $5,000 worth of risk now, because theoretically the market can go to zero. Those shares could drop to zero. The likelihood of that happening obviously is pretty slim, but the point being is you've got $5,000 worth of risk. Or you can buy a 50-strike call that maybe cost you $2. It gives you the same control over those 100 shares of stock. You've got the right to buy that stock at $50, but now you're only risking $200. You're only risking $200 as opposed to $5,000. All right, so options are definitely a flexible tool that allows us to use our capital more wisely, and that's a premise that we're going to get into with the rest of the third quarter here. Greeks, again, we've seen a few questions coming across with Greeks. Greeks are just theoretical predictions, theoretical values that help us anticipate what our option might be worth, assuming a movement in the market or a movement in volatility, movement in interest rates, etc. Passage of time, again, I had mentioned that, for option buyers, time is not on your side. Definitely in favor of the option seller. They want those options to go to zero. Option buyers, however, want their options to increase in value as much as possible. And then implied volatility, that does, in fact, work in favor of option buyers. As the implied volatility increases, so does the value of that option. Just to remind everybody about our optionseducation.org website, we've got podcasts and videos, our live events that we do quarterly throughout the country, and the webinars that we offer as well. And then the pride and joy of OIC, our investor services desk. So make sure you copy down the information on this slide. Optionseducation.org is our website. Email address, options@theOCC to reach our investor services team, or you can contact us on our website via live chat. Like us on Facebook, follow us on Twitter for all the latest updates. And ladies and gentlemen, thank you so much for joining me today. We'll see you soon. Take care.